Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of deferred tax liability. What is a deferred tax liability? What are the various journal entries for deferred tax liability? How this deferred tax liability should get reported in financial statements? All these details I would be explaining in this video. With the description of the concept which is deferred tax liability, this is evident that this is something related to the liability, which means this doesn't impact my income statement. This only gets reported in my balance sheet. Okay. And this deferred tax liability would primarily arises because of the temporary differences which are being raised between my book profits versus taxable profits. Okay. What is a book profit? What is a taxable profit? What are the temporary differences? What are the permanent differences? On all these concepts, I would be posting videos in my channel soon. Okay. With this introduction, let's move to the next slide of this video. Yeah. In this slide, there is a diagram which depicts like a cycle. This is nothing but the accounting cycle. What is an accounting cycle? What are the various phases of an accounting cycle? All those details I had already shared in my previous video on accounting cycle. And also I would be giving the link for that video in the below box. I request the viewers to go through that video before getting into the details of the current video in order to gain better understanding of the current concept on deferred tax liability. As mentioned, uh, as mentioned previously, I would be explaining my each and every concept with an example. Okay, to explain this concept, I would be taking an example of a depreciation expense. Okay, and also considering the various phases of an accounting cycle. What is my first phase of an accounting cycle? Which is nothing but the business transaction. And what is my business transaction? Deferred tax liability is my business transaction. So to explain this deferred tax liability, I would be considering an example of a depreciation. As explained in my previous slide, this deferred tax liability would primarily arises because of the temporary differences between book profits versus taxable profit. To explain this better, to explain this concept in a better way, I would be considering an example of a depreciation. Depreciation is an expense which is normally provided on the fixed assets for wear and tear of the assets. Okay. What is a depreciation? What are the various methods of depreciation? All these details I would be providing in my future video on depreciation, and the same would be posted soon in my channel. Okay. For now, just treat it as a depreciation as an example. Okay. Okay. For book profits purpose, an entity can adopt a method of straight line method to provide this depreciation as an expense. However, for taxable profits or to compute the taxable profits as per tax purpose, the entity organization is supposed to adopt only the WDV method, which is written down value method, for computing the depreciation expense, because the tax authorities generally don't accept the straight line method for providing the depreciation as an expense. Okay, so which means what happens, there are changes in the methods in providing the depreciation expense between book profits versus actual profits. Normally, when the depreciation is provided as per WDV method, the expense would be at the higher side in the initial years, and gradually it would get reduced during the course of the business, which means when the depreciation or the expense is higher, my profits would be lower, right? So, which means my taxable income would be at the lower end when compared with the profits which are being computed as per book profits. So, if my taxable income would be at the lower side, normally my tax would be at the lower side when compared with the tax which has been computed as per book profits, right? So, whatever the tax difference between the book profits versus the actual profits, that difference we need to consider it as a deferred tax liability, right? Because my book profit income is more than the taxable profits income, right? Then in such a case, there would be an excess tax would get computed as per book profits. Whatever the excess amount which has been computed as a tax, that amount we need to consider as a deferred tax liability. Because even though that amount is not going to be paid now to the tax authorities, that would get paid during the course of the business over the time. However, as the income has been computed on an accrual concept, so whatever the income which has been generated or the depreciation expense which has been computed, on those lines the income has been computed and the tax has been computed accordingly. Even though the tax is paid to the department authorities at a lower side, over the time that would get reversed out and would get adjusted accordingly. So hence till that point of time, that excess would be considered as a deferred tax liability. Hope this is clear. Now let's move to the next phase of my accounting cycle, which is generalizing phase. Okay, what is the generalizing phase? In this phase we are supposed to create the journal entries for the business transaction, right? Whatever the income tax which has been computed as per book profits, that would be considered as an expense, and the same thing would be debited as part of the journal entry, right? So whatever the amount which would be paid to the tax authorities, that would be credited to my bank account. So whatever the difference would be there, that would be credited to my deferred tax liability account, right? Hope this is clear. Now let's move to the next third phase of my accounting cycle, which is a ledger postings or creation phase. What does this phase is all about? For whatever the journal entries which were created as part of my generalizing in second phase, for all those accounts, I am supposed to create the ledger accounts and the entries are required to be posted accordingly. Okay. So how many accounts were being created or the entries were posted? There are primarily three accounts. What are those? Income tax expense account, deferred tax liability account, bank account. So all these three accounts, I am supposed to create the ledger accounts as part of my third phase, and the entries are supposed to be posted accordingly. Okay, hope this is clear. Let's move to the fourth phase of my accounting cycle, which is trial balance phase. What is my trial balance? Which is nothing but the summary of the balances of all the ledger accounts, which means whatever the postings which were being done as part of my ledger postings, so the balances for all those accounts are required to be updated in the trial balance. For how many accounts the ledger postings were done? Three accounts. What are those? Income tax expense account, deferred tax liability account, and the bank account. So the balances for all these three accounts are required to be updated in the trial balance. So whatever the debit balances which are shown are updated in the trial balance should get matches up with the balances which are shown under the credit side in the trial balance, because as mentioned several times, as we have been following double entry system of bookkeeping, there will not be any differences in amounts between debits and credits. The amount should get matches up. Okay, and let's move to the last phase of an accounting cycle, which is a financial statements phase. What are the financial statements which covers? Primarily, one is the income statement and the other one is the balance sheet. As part of the income statement, this income tax expense would directly debit to my income statement account, and in the balance sheet, this deferred tax liability would get reported under liabilities in the balance sheet, and this bank account would get reported under the assets in the balance sheet. The balance sheet should get matches up, because as we have been following double entry system of accounting. With this, hope the viewers are clear what does this deferred tax liability all about, how these journal entries are supposed to be made, how this deferred tax liability should get reported in the financial statement. If you guys really like my video, request you to like it, share it to your friends, and subscribe my channel for more videos. Thanks for watching.